Good morning, everyone, and thank you very much for joining me. This is the morning market review. It's Monday, and it's the 4th of September. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address rshaw@fxcm.com. And of course, if you need to get hold of me, that's the address to use. By the way, just with regards to emails, I generally do respond. So if you're still waiting for an email from me, just check your spam folder. I suspect that some emails may be directed through to spam, so just check that out. All right, let's just bring up the disclaimers. Here's the high risk investment warning. I'm going to keep this on screen for a few moments. Good morning, Kim, and thank you very much for joining. Pleasure to have you on the webinar as always. Good morning, James. Thank you very much for signing. Pleasure to have you on the webinar. Thank you everyone for signing in this morning. It is much appreciated. Just going to bring up the market commentaries disclaimer. Amir, good morning to you. Welcome. All right, and just our references, market scope and trading view. Let's just bring up trading view. I think that's quite interesting. Taking a look at the real yield here, and after the non-farm employment change, the non-farm employment change on Friday, there was a big sell down, only to have that the bears lose control, or the doves lose control, and then hawks pushing real yield back up. If you take a look at the daily chart, you can see how we've actually got quite a big candle for Friday. This is the 1st September. If you go through to the 2-year yield, let's just go to the 2-year, which is effectively a measure that reflects monetary policy. Let's just bring that up. You can see how there's this big sell down, then the bears lose control at the bottom, bulls push it right back up. So very interesting reaction to that non-farm employment change. When we traded, the volatility was thin. No real volatility. We moved sideways, didn't we? I'm just taking a look at my notes here. 187,000 added. Unemployment ticking up to 3.8% and average hourly earnings coming down. And still, we get this sort of bullish candle here. I think that's quite strange. And if we take a look at the US dollar, I'm just bringing up the US dollar. Let's just take a look at the daily chart. So here's Friday's candle. There's a big movement up in the US dollar. And I found that quite surprising. But where I think it really counts is on the weekly chart. Let's just go through to the weekly chart here. And I want to show you something that's very subtle and something that we need to keep our eye on. Hi Howard, morning to you, welcome. What we'll be looking at is effectively 2 points on the weekly. We've got so upside down, we've got a trough and a peak. A trough and a peak. Okay, we need 4 points for a trend. So let's just take a look at this again on Microsoft Paint. 4 points for an uptrend. You've got 1, 2, 3, 4, and what those are in terms of peaks and troughs: trough, peak, higher trough, higher peak. Now we get to the question of how strict do we want to be in measuring between 2 and 3. And if we've got candles like this, okay, we can put in trough peak. Now watch this very carefully, because this is the subtle part. If I get something like this, it's like that. I'll try to get it as straight as possible. There we go. Look what we've got here. We've got a candlestick that's got a lower high and a lower low. Strictly speaking, that is the higher trough, okay, until it takes out this trough over here. So if we go back to the weekly chart here, look what we got here. This candle here has got the lower high and the lower low. So what we might be seeing here is the higher trough. Okay. In other words, this is the third point. If it's the third point, okay, if it's the third point, then it's not going to take much for us to get the higher peak. Then we've got dollar moving in higher in an uptrend. So what am I trying to say is that we had very strange price behavior on Friday that's giving us a very interesting possible scenario for the dollar. What's that scenario? Dollar might be moving into primary uptrend fairly soon, just because of one candlestick. So let's just keep an eye on that. You can see that the RSI is above 50, okay, and we've always said that the RSI below 50 helps divide the bullish and the bearish side of the oscillator. And now we're getting some sort of potential third point. If we take a look at the monthly chart here, we have for the longest time mover sideways. Okay. What's interesting is that the trend following indicators, which are our green 5-month exponential moving average and the orange 10-month exponential moving average, they're starting to diverge. So they are starting to show some sort of bullish movement. Okay, and I think that this is kind of the area. Let me use a appropriate line study. I think if we move above then this high over here, I think we can say that the monthly chart moves into uptrend. We can see that the RSI is starting to pull away from 50. So there does seem to be some strength going into the dollar. Now, that does have me concerned on one front. What's the front? The dollar is generally considered a safe haven. So that's strange. There is money going into the US dollar. US dollar is a safe haven. That potentially suggests that we could be facing some headwinds. Okay, so let's just go down to the US indices and do some analysis on the US indices just to see if there are headwinds that are facing them, and then we'll come back to the US dollar. Let's just go through to the NASDAQ, which is our growth index. Okay, so we just bring up NASDAQ, and strange as it seems, it does look as if the NASDAQ's coming in with this higher trough here. In fact, we can take this question mark out. So now we've got an ambiguous situation. The situation is, it looks as if there's some money creeping into the US dollar, and at the same time, it looks as if the NASDAQ is getting support as well. I'm not too comfortable with that. That means that one of the instruments seems to have a mispricing associated with it. And the truth be told, at the moment, I would suspect it's the NASDAQ that's facing the headwinds, not the dollar. Why? Is because the is because the rates are still fairly high. The yields are still fairly high. And if we done the time value of money, which we'll do just very quickly, just to drive the point home, then the pressure would probably be on the risk side of the market. Just bear with me. We do a little bit of mathematics here. And what I want to show you, we've done this formula before. Just bear with me. We've got a formula that looks like this. I'm sure you guys have seen the formula future value equals present value 1 plus, I'll just put I for interest, it's actually rate of return, and that's to the power of n. Okay, so now we can rearrange the formula. So the present value, what the current values are, will depend very much on what the future value is expected to be, divided by 1 plus r to the n. Now, I'm just going to do some maths for you. Just want to show you the effect of a higher interest rate. I just want to show you the effect of a higher interest rate on the NASDAQ. Okay, so that's I'll do sort of I'll punch in the numbers. Don't get too flustered over this. The idea is just to understand what happens when interest rates go up. So what we're going to do is we just put in a future value. Future value equals, let's just put that is 100. Let's put interest rates equal to 5%. And the thing with the NASDAQ typically sees dividends paid into the future. So we'll just put our N equal to, we're only going to see dividends in 5 years' time. So if we can put in the numbers, we go 100 divided by 1 plus 5%, okay, to the power 5. And I have no idea what that is. I'm going to just throw that into my calculator. Yeah, you can do it yourselves as well, but let me just throw that in. So we've got 1 plus 5% to the power 5 divided by 100. Okay, it gives us a present value of 78.35. That's what our present value is. Okay, now what we're going to do is we're going to just assume, okay, now I just want to make sure you guys understand. I'm telling you that interest rates are looking higher. So instead of a 5% interest rate, let's make it an 8% interest rate. Okay, so what we'll do here is we'll make this 8%. Okay, so let's take a look what the 8% does to the present value. So it would be 100, okay, divided by 1 plus 8% to the power 5. So the only thing we've changed here is the interest rate. So let's throw that into the calculator. 1 plus 8% to the power 5, and we divide 100 by that. And we get an actual present value of 68.05. In other words, okay, when you've got a higher interest rate, so here the interest rate, the only variable we changed was the interest rate. We changed it from 5% to 8%. As that interest rate went up, there is pressure on that present value. The present value went down from 78 to 68. Okay, so what we're saying here is, well, there's something interesting going on. What's interesting is that yields are moving up. If we take a look at the real yield, okay, so we just go a US 10-year and minus, put in your 10-year break even. Okay, you can see here that the interest rate really moving up quite substantially. And then we've got some sort of anomaly where we're getting the NASDAQ showing some signs of resilience at the same time that we're getting the US dollar showing some signs of resilience. To me, that seems a bit odd. I don't think both of them can show resilience. One is a safe haven, and one is a risk. One is a risk item. So to me, they should be almost opposing one another. And the idea here is, well, as long as the yields remain high, then the Nasdaq is going to be under pressure. What really surprised me in terms of the yield, okay, what really surprised me in terms of the yield was the price action. The price action showed that after the non-farm payroll, we're actually getting a climb here, in the yield. That's got me a little concerned. We've got to keep an eye on that. And you can see this looks like a technical pattern. It looks like a flag formation. Okay, it looks like a flag. There we go. So is there going to be a push out? And if there's a push out, a breakout to the upside of the flag pattern, which tends to be what we call a continuation pattern, that to me would insinuate some sort of headwind for the risk market. And we've seen the time value of money there. Okay, let's just go back through to the US dollar now, because if the US dollar is the item that's mispriced, okay, then we want to start seeing more movement to the downside like this. All right. Let's just see how the dollar is positioned on our daily chart. And you can see that it's in zone 1. Okay. And if it's in zone 1, we want to see on the hourly if there's some sort of support. And what we can do here is keep an eye on the central pivot. The central pivot seems to have a nice overlay right there, a nice overlay of resistance turning potentially into support. Here is the resistance 1. Here is the resistance 2. And then polarity suggests that potentially becomes support. Okay, we can actually extend this all the way to this point over here. But in order for that to truly be a key reaction level, we'll need to see the EMAs. We'll need to see the EMAs turn positive, okay, and we would need to see the stochastic turn positive. So I'm just looking to see if the support's going to hold, and if the support's going to hold, I need to see the triggers from the EMAs and the stochastic, and then of course I would want to see the stochastic move into the upper quintile. Let's just take a look at the euro US dollar just as the last chart for this morning. Just want to see if there's any comments. No, we're all good. All right, just bear with me as the euro US dollar comes up. My system seems to be a little slow this morning. My profuse apologies. Okay, let's take a look at the weekly, and you can see that well, we've broken down through this higher trough, so we can take that out. We can see that the euro has some downside to it. It is in zone 3, and if it's in zone 3, well, we can keep an eye on that central pivot. See if the central pivot here holds. And again, I don't know if it's going to hold. The way that we're going to tell is we're going to look at the EMAs to cross over, and we're going to be looking at the stochastic to cross over. One more chart before we sign off. Let's take a look at DAX. It's just gone cash open. Let's take a look, see what's happening on DAX. All right, taking a look at the weekly. So there does seem to be some sort of support here. Okay, there does seem to be some resistance turn support. There is a movement above 50 here. Just heads up, if the Nasdaq is going to come under some pressure, I would suspect that follows through to global risk markets. So there is some sort of resistance over here. So it's making this analysis extremely difficult. We are in zone 2. That's between the neutral area. I'm not surprised about that. There is a ton of what we call stale bulls, a ton of resistance right through there. So the DAX not quite clear. It doesn't have a clear path. So that's what we're dealing with. I think that we need, at the moment, it seems a little bit ambiguous. Risk market looking supported, dollar looking supported. I'm not sure they both can be. So some sort of correction one way or the other. How do we assess that? I think we carry on looking at the real yield. All right, are there any questions? Let me just take a look. Any questions? Okay, thanks, James. Have a great day as well. All right, guys, let's wrap off here. Let's wrap up here and let's sign off over here. Thank you very much and very much appreciate your attendance. Cheers, guys.